Good morning, everybody, and welcome to today's midweek update. Just like every week, we've got plenty to talk about here. First, we will be talking about the power trend. If you've never heard about the power trend, you're going to learn about it today. The power trend is on, and we will be talking about it. Next up, I'm talking about pullbacks. And should we be expecting the pullback? I kind of think we should at least be ready for when the pullback happens. After that, be talking about how to deal with pullbacks, questions to ask ourselves, and go through some of the key highlights of the indexes. So before we get into all that, I want to first say thank you all so much for being here with me today. It's always a pleasure to be here with you. Let me know in the comments where you're logging in from. If you haven't already subscribed to wherever it is that you're watching us from, go ahead, click the like and share button, and we will be answering all of your questions as we go through this. So make sure that you are posting into the chat, and I will get to your questions as we go through this. So let's talk about the power trend. And what exactly is the power trend? So the power trend, as you can see here in this chart, there's actually a lot of things going on in this chart right here. Let me turn off my annotations and talk a little bit more about this indicator way down here. Make it a little bit bigger for you guys. You see that little green spike over there and how this is moving up? And that is what's identifying this power trend. So the power trend is something that my friend Mike Webster came up with. He is the vice president of strategy over at IBDA. Pretty sure that's his title. Mike, if you're watching out and that's not your title, I apologize. But that is his, he's the one that helped come up with this. He co-founded this idea of the power trend. And what happens is that when the 21 period crosses above the 50 period moving average, and you have the moving averages stacked, and you're getting this follow through, and you're getting this uptrend here, what he identified when he looked back throughout history, and this is something that I recommend you guys do too, if you truly want to study markets and really want to master this stuff, you're going to want to go back in time and study history. So when he did his study, he noticed that when these certain things stacked up, it had lots of momentum in the market. It was a huge indicator of momentum in the market, and that's what the power trend is, and that's why he wanted to come up with a way to identify when this is in effect and how likely it is to stay in effect. So came up with all these different rules. And what's happening right now, what we see in the NASDAQ with the price moving higher, it's what he calls the power trend. So it's a time to be a little bit more aggressive and to give stocks a little bit more room. I learned all this stuff in his course in market school. Not his course, but the IBD market school course, Investors Business Daily market school course. For those of you that haven't heard of what Investors Business Daily, it's basically like the Wall Street Journal, kind of like the Wall Street Journal, but better. It's focused on growth stocks. It was founded by William O'Neill many years ago. William O'Neill passed away, I believe it was last year. Might have been last year or the year before. Time is flying. God rest his soul. And he did so much to help this community, us, retail investors, right? The individual investor that's trying to make sense out of the market. He studied history, wrote several books, one of them being How to Make Money in Stocks. And he founded Investors Business Daily. Anyhow, I took that market school course, learned from Bill, learned from Mike Webster, and that's how I came to appreciate understanding this quote unquote power trend. Now, the way that I like to also look at markets is to take a look at this Venn diagram that we've been talking about for the last couple of times here. I'll bring up the Venn diagram one more time for those of you that haven't fallen asleep quite yet. Let me bring this up over here and share it with you. So I'll just stop the screen share for a moment and then share this Venn diagram with you. So we've mentioned this Venn diagram a couple of times. This is how I like to view markets. I like to take a look at the general market, all of the inner workings. So general market, five major indexes: the S&P 500, the Nasdaq, Russell 2000, New York Stock Exchange, and the Dow. I look at all five, and I look at all five across time frames: monthly, weekly, daily time frames. And how they're moving will impact how the market is moving. So if it's in a steady uptrend and all time frames are moving steadily higher, then it's going to be a more powerful trend. If you start to have one trend moving up, another trend moving down, that's going to create choppy waters. So when I look at the general market, that's what I'm looking at. But that by itself isn't enough. I also want to see what the system is doing, the types of stocks that you're interested in, how are they actually performing? Because if you see the market moving up, but the types of stocks that you're interested in are flatlining or not following what the general market is doing, then it's still not a time for you to be buying those stocks. Maybe you end up buying something else. Maybe you end up buying some ETFs that follow the general market. Maybe you buy some leveraged ETFs that follow the general market. That's a tactic that I like to use. Maybe you're doing that. But as far as the stocks that you're interested in, that tells you something critical about the general market, about the overall, what I call market mood. And then, of course, your personal performance, because if you have a mechanism to find the best stocks in the market, right? And that's what we're after. We're after the high probability, high reward, low risk stocks, low risk trades. Then if we're taking those and they're not performing well, that's going to tell us something else about the market too. It should be the canary in the coal mine, especially if we're trading leading stocks. Because if we're trading leading stocks, then they'll be the first ones to break out, they'll be the first ones to break down. And so that's how I'm using this. Now to switch back over to the NASDAQ, what we were looking at just a moment ago, right? So back over to this here. Turn on my annotations. So we've got all this red, yellow, and green stuff going on right now. The power trend turned on over here, right? At that point, I'm in agreement with the power trend. There were plenty of stocks that were breaking out. Performance was doing well. General markets in an uptrend. Then yesterday, day before, something happened that started to be a little bit of a yellow flag. That yellow flag ended up being this indicator down here. Let's make this one a little bit bigger now. This here is simply tracking the number of stocks that are making new highs versus new lows every single day on the NASDAQ. The reason why that's important is because there has never been an uptrend that's lasted more than a couple of weeks without the number of stocks making new highs outpacing the number of stocks making new lows. Now, the new highs are still outpacing the new lows as of yesterday. But what I observed was that the ratio of new highs to new lows started to level out a little bit. We had about 74, I believe, new highs and 49 new lows. So when that's starting to narrow, I want to start to get ready, start to get a little bit more defensive, start to raise stops, maybe take smaller risk on new positions versus going in with, say, 25% of my capital on a new position. So that's where we're at right now. And given how far the market has run, right? Well, let's make this small and make this indicator small again. Bring this down. Given how far the market has run, right? We've had this Nice big run. If we measure from down here to where we're at right now, that's almost an 11% move since the middle of April. That's very strong. Now, that's the NASDAQ. That's not a stock. To move that far in about a month, it's a lot. So, what I'm getting at is that we're starting to get into the territory where you might anticipate a pullback. Doesn't mean that the market will pull back, but you would, if you anticipate it, then you can be ready. And what I would be ready to do would potentially, depending on these three questions, right? I mentioned three questions earlier. When the pullback happens, where the pullback happens, and how the pullback happens. So there, would you agree that if I grab the pen over here, well, let's see, well, where's the pen? I think it's in this. Yeah, there it is. So would you agree that there would be a different kind of move, like say if price was steadily moving down like that versus a pullback that happens like this? Very different move, right? So we need to be prepared for both scenarios. And if price is steadily going down like this, then maybe you are raising your stops, maybe you're looking for some new positions. If price suddenly drops like this, and let's say it actually does test that red line there, that's the 50-day moving average. That's where price tends to be defended. It's a very important line in the sand. If price suddenly dropped to that level, what would you do? Do you have a plan for that? I know what my plan would be. Do you have a plan for that? I'll tell you what my plan would be if we had a sudden drop to the 50-day moving average. What I would do would be to start to look, could I get long at that level with a very small amount of risk? Earlier today, one of our members was asking me about this trade here in sweet greens, right? It's important to share wins. It's important to share losses too. And I want to make sure that I'm doing both. So this is a trade that I lost on yesterday. I entered the trade right here. Let's move this. I entered the trade right here. So I got in on this day and it was up pretty nice on the day. And then all of a sudden, yesterday, it pulled back. And this was a pullback that all of a sudden it just sliced right down, hit the stop loss. Right, so lost 5% on that trade. When that stop loss was hit, it kind of came out of the blue because price was doing pretty well for most of the day and then stopped out, heard the alert go off. So I took a look at the price action. And what I saw was this here. I saw this rapid spike down and I saw price starting to recover. So what I started to do at that point, and actually, why don't I put this on a 5-minute chart? You might have a better idea. Yeah, you see that spike down? That happened in 5 minutes. So when that happened, and I'm seeing this happen in real time, what I wanted to do was to buy back and to buy back larger. So I went in with 25% of my capital, right? So if you are trading, say, a $100,000 account, 25 grand. If you're trading $1 million account, 250,000. So I'm back in this trade, and the reason why I went in with such size, he had asked me, well, was that a revenge trade? The answer is no. The reason why I went in so large is because of something that Van Tharp talks about in two of his books. If you don't know who Van Tharp is, brilliant man, also passed away, unfortunately, but a fantastic author, and you could read his work, Van Tharp. So, two of his books, Super Trader and The Definitive Guide to Position Sizing. Now, as you might expect, this guy knows quite a bit about position sizing. So, well, what he would talk about would be if you could find a high probability, high reward to low risk trade, then you could really size into this thing provided that your risk is just this small. So when I got back into this after being stopped out, I re-entered the trade at about $31.70. My stop on this trade was about $31.50. So I'm only risking 20 cents per share on the stock, right? So when I went back in with a $25,000 capital allocation, right? 25%, I was only risking 0.15% of capital, 0.15% of capital. That's nothing. That's pennies. That's maybe, I think it was a couple of $100. Not much at all, right? To have that leverage for this to rally. Now the trade didn't pan out thereafter. I was able to make some money back. I was able to price. I believe I sold at about 31.90. Not that much at all. It's still something, but I was. The point is that because price spiked down, and I was able to identify a clear level of support and be able to get in so close to that danger zone. And that's what I would point out to you too. If you're buying that close to the danger zone where you're able to just get out, then you're creating the asymmetric reward to risk for yourself. You're creating a scenario where you could risk just a tiny amount, have huge upside, and get in with some size. Let me know if that makes sense to you. Let me know if you have additional questions on that. That's a little bit on the advanced side. While you're getting your questions in, let's go through some more of the highlights here. All right, so daily indexes. We spoke a little bit about the daily indexes. We talked about the Nasdaq, the other indexes, the S&P 500, Russell 2000, NYSE, Dow. They all look similar to this here. So well, we won't go through each of them. We spoke about the number of stocks making new highs and new lows. We spoke about how the number of new highs started to dwindle, right? With the index pushing progressively higher, it's kind of weird to see new lows taper off, right? Well, what's pushing the index up if it's not the stocks within it? They can't go up all the time, but well, what's pushing the stocks up? Makes you start to wonder, and it's one reason not to dump the baby out with the bathwater, but to maybe start to get a little bit more defensive. Maybe put on slightly smaller size if you're taking a standard trade, right? Taking a look at trades and performance. Sweet Greens was a top performer, and then it did this, right? That's abnormal behavior. Want to be careful. Let's see. What questions do you guys have? Let's go to the comments over here. Get your questions in. Got a bunch of people watching live, so expect you to have some really good questions in here. Let's see. All right. Question from Instagram. I work as a psychologist here in Brazil. I coach day traders and I really enjoy your book. Oh, well, thank you very much. The Trading Mind Wheel, which you can see a tiny version of it over there. Let me grab a copy of it. The Trading Mind Wheel just made its 1-year anniversary. And this book, having written this book, this has been such an incredible journey with this. The reason why I say that is because I used to be a kid that hated reading. I had a terrible stutter, and writing a book was never something that was remotely on the radar. Then last year, I'm standing inside a Barnes and Noble, doing a book reading, signing books, and man, oh man, what a journey it's been. And far more important than any of that is the people around the globe that this book is helping. And so I really appreciate your comment. Thank you so much. And for those of you that haven't gotten the Trading Mind Wheel, go get it. It's on Amazon, and there's loads of bonuses too. Loads of free bonuses that you could get if you go over to tradingmindwheel.com. You could get bonuses after you purchase the book. Let's see. Well, what else? Do you read the chat from YouTube? Yes, I do. I just did. I'm currently reading your book, The Trading Mind Wheel. Really enjoying it. Oh, thank you very much. Thank you. Keep it simple. Um, Also from YouTube, which country are you from and what exchange do you use? From the US. Uh, the exchanges, well, I'm trading NASDAQ stock, so I'm using those exchanges. I primarily trade stocks. I also trade crypto. When crypto was setting up properly, there was some really great crypto trades just the other day. Let's get this back on here. And let's get over to this stuff here. So Bitcoin. Let's get over to daily chart of Bitcoin. So Bitcoin has been fantastic. Added some more Bitcoin, I believe over here, as it was pushing back through the 50-day moving average. Yeah. So Bitcoin is one where I've bought and held this for a very long time. I actually started a position in Bitcoin way back. And let's go back to the chart over here. I'll reset this real quick. Is this Bitcoin? No, this is a 5-minute chart of Bitcoin. What are we doing here? Way back here. This is when I started trading Bitcoin. Back there. Well, let's make this a little bit bigger. Back here, back at the $27,000, $28,000 mark. The reason why is because the 50-day moving average, it broke out, setting up. You had that tight reward to risk, right? I only had to risk about 5.5%. When you can have asymmetric reward to risk, it pays off. You don't need to win every trade. I probably win about 50% of the trades that I put on. But if I'm risking 5.5% and say I lose 5.5%, but I gain so far on this trade in Bitcoin, right? It's at 70,000 now. I've more than doubled my money in Bitcoin. So if you can have 100% gain and only lose 5.5%, you're doing pretty well. Most of the time, I'm my winning trades are probably making about 10%, I'd say, on average. 10%. And if you're still risking 5% to make 10%, well, if you were paid $2 on heads and you lost $1 on tails, wouldn't you take that trade? I take that trade every day of the week. So let's see. A bunch of questions coming in now. Just got done with chapter on mindset. The exercises took quite some time. Yeah, they took me quite some time too. When I was going through the exercises on mindset when I was doing this. But that's good. That's good. That's a sign that you're being thorough. What is my take on Forex? Forex is great. It's just like I think that you should trade the asset class that you find most interesting. For me, it happened to be stocks, and that was because stocks were the first ones that I was presented with. I started trading back in 1999. It was a nightmare for the first 10 years. Had I been presented with Forex back then, maybe I'd be a Forex trader. But I started out with stocks, it stuck, and here we are. Lots of great Forex traders out there. I'm friends with several of them. Check out Jason Greystone. Check out Akil Stokes. Check out Austin Silver. Um, check out Rolf Schlotman. We were just talking about journaling. So Rolf created this journal called Edgewonk. It's one of the more popular journaling softwares out there. He and I have known each other for years. If you're interested in Edgewonk, go check, or interested in a journaling software, I would recommend checking out that one. Personally, I prefer to just use a spreadsheet. Uh, it's a little bit more labor intensive, but not so labor intensive, especially if you know how to work spreadsheets. Let's see. Speaking of crypto, let's post this one. Speaking of crypto, when you're trading different asset classes, do you use different accounts for them, or do you take positions from the same account and consider it to be one portfolio? Great question. So I will separate out everything. Right. So I have, how many accounts do I have? I think I have about 5 accounts. I have I have 2 crypto accounts. I have my IRA. I have a swing trading account, so personal account, and I also have another swing trading account too. So in total, I have 5 accounts overall. Uh, 2 dedicated for crypto. One of them has a mishmash, right? So one has this mishmash one that I just mentioned. This is over in interactive brokers, right? And so the reason why that one ended up being a little bit of this, a little bit of that, I use it as a testing ground. But one of the things that they recently started allowing people to do is trade crypto in that account. So I put on as much Ethereum as I could in that account, and I found out that they only let you put on up to 10%. So when I was trading Ethereum, when I got into Ethereum, I actually started the Ethereum back there. Well, let's make this a little bit bigger. Right, so I started Ethereum position back here at about 1800. Ethereum, I believe, is trading at about 36 right now, something like that. And let's reset the chart. Well, where is it? Yeah, 3600. So this, so I'll separate my accounts based on asset class, based on strategy. It's very important, especially if you're going to be trading multiple asset classes, multiple types of strategies, to keep them compartmentalized. Otherwise, you end up muddying the waters. It will be far more difficult to keep a strategy straight in your head. It will also be more difficult to reconcile your account. How do you know which methodology is the one that's working out well for you? It's a lot easier if you keep the accounts separate. And also, uh, in the event that a broker goes down, right? Well, we want to have uh, the when it hits the fan plan, right? You know what I'm talking about. When things go awry, you want to plan for all sorts of things. So let's say you lose access to a broker. Let's say that a broker goes down and you have a bunch of open trades in that position. And now you're worried, uh-oh, I can't exit. What do I do? If you have other accounts set up, you could take reverse positions to what you have. So that way you're hedging, right? So at least that way you're maintaining the status quo. And it's 11:30. Unfortunately, I have to hop off right now. I do have another appointment, but I do want to say thank you all so much for being here today. It's been an absolute pleasure. And I will see you back here on Friday for the next live stream, the Traders Mind Chat show. Make sure that you subscribe wherever you're at. You'll get the notifications. You'll know when we're going live. And if you're not already on the newsletter, we have a free newsletter that goes out multiple times a week. Go to marrowwealth.com/newsletter. Till then, take care. Much love. Peace out, everybody.